Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today we have got a practice question which requires you to prepare the journal entries and correct the errors and also identify the relevant amount that we need to write off for irrecoverable debts. Lastly, we'll discuss an accounting theory which requires us to do the allowance for impairment on trade receivables. So you can see the question on the left-hand side of your screen, and then you can also see the workings on the right-hand side. So I'll go through all of them step by step. What I need you to do now is focus and follow through for an excellent understanding. With that being said, let's begin. The trial balance of Feda's business balanced on 31 July 2021. However, the following errors have now been discovered. So you can see we are given three errors, and the requirement in part A is to prepare the journal entries and correct these errors, and no narrations are necessary. So let's start with the first transaction that we have got. A check received for a cash sale of $1,300 for goods which had a cost price of $350 had been correctly recorded in the inventory and cost of sales account. No other entries had been made. All right. So every time we sell something in our business, there are two pairs of journal entries which we must perform. The first set is to ensure that we are recording the sales revenue, and the second one is to also ensure that we are recording the cost of sales for that specific item which we have sold. Now, based on the information that is given to us, we understand that we have made a cash sale and the funds were deposited in our bank account by check. So obviously our bank account is increasing in value. Bank account in itself is an asset account. What happens when assets increase in value? Do we debit them or do we credit them? So we debit them. So we debit the cash at bank account by $1,300, and simultaneously, because we have made a sales, we have to recognize that we have sales revenue. So we credit the sales revenue account by $1,300. So every time you have sales in your business, it is always credited by default. All revenue accounts, all sales accounts are credited by default. And at the same time, you can see our assets are increasing. That's why we are debiting the cash at bank account. Now, we also have a cost component because the inventory which we have sold to our customer for $1,300, we do have a cost as the business owner to bring that inventory into our business in the first place, right? And the cost we had to pay to our supplier was $350. So in our books, we now need to make sure that the inventory that we hold in our warehouses now needs to be reduced by $350. So inventory in itself is an asset account. When we are selling this inventory is going down in value, especially in terms of the cost component. And because inventory is going down in value, asset is going down in value. And when assets go down in value, we credit them. So we credit the inventory account by $350. Simultaneously, we have incurred an expense, which is what we refer to as the cost of sales. All expenses, whenever we incur them, by default are to be debited. So that is why we debit the cost of sales account by $350. So as you can see, whenever we have a sales transaction, whether it's on cash or on credit, there must be two pairs of journal entries, two sets of journal entries. And in most cases, it would be 4 lines, okay? Now, what is the type of error that actually happened here? Because we have forgotten to record this transaction entirely, this is what we refer to as an error of omission, okay? So your trial balance may necessarily also balance whenever there's an error of omission, given that you have failed to record a correct amount of debit and credit, which would still end up balancing the trial balance, right? So error of omission is not detected by the trial balance. So this is something you should also know. So now let's move to the second error, which we have got. Salaries of $1,500 paid by check had been debited to the cash and bank account and credited to the salaries expense account. All right. So when we read this first few words, salaries of $1,500 paid by check, just by reading these first few words, how should we correctly record this? We should debit the salaries expense account because obviously we have an expense that is being incurred due to the staff and employees that we have hired. They're working for us and now we owe them salary. So there's an expense that we are incurring. And whenever we have an expense in the business, it is always debited. So we are debiting the salaries expense by $1,500. Simultaneously, when we are paying these people by check for their salaries, the funds available in our bank account must also go down in value, which is an asset account going down in value. Therefore, we must credit the cash at bank account to reflect the reduction in that asset. And in this case, it's again credit cash at bank by $1,500. So this would be the correct way to record based on those first few words, right? But look what happens afterwards. They're saying that the way it has been recorded is that they debited the cash at bank account and they credited the salaries expense account. So obviously they have done the complete opposite, where they debited the cash at bank account and credited the salaries expense account. So a complete opposite of what we should be doing. Therefore, this is what we classify as an error of complete reversal. Okay. Now, how do we correct this? So we ultimately want to end up, after the correction is done, with a net balance of $1,500 debit in the salaries expense account. Again, net balance, okay? Which means after all the transactions have been sorted, the last balance to be remaining must be $1,500 once the correction is done. And also, we want to end up with a net balance of $1,500 credit in the cash at bank account. Now, where am I basing these numbers from? So this is from the correct way to record entry that we have originally prepared, which mentions that we should have debit $1,500 in salaries expense and credit $1,500 in cash at bank. So this is the goal that we want to achieve. So how can we fix this? So look carefully in the way we have corrected this. So we want to end up with the debit balance of $1,500 in the salaries expense. What is in the books at the moment is a credit balance of $1,500 for salaries expense. So how do we end up with the net balance of debit $1,500? We debit salaries expense by $3,000. Because when we debit salaries expense by $3,000, what essentially happens is that the first credit incorrect entry of $1,500 is entirely offset, and what is left afterwards is $1,500 with more debits in the salaries expense account. Okay, a same approach to fix the cash at bank account. So if we credit the cash at bank account by $3,000, what will happen is that first, it will offset the entire debit of $1,500 in the cash at bank account that we already have as an incorrect entry. And after that, it is going to leave us with a surplus of credit $1,500 in the cash at bank account, which is our goal, right? So the correction is to debit the salaries expense by $3,000 and to credit the cash at bank account by $3,000. And we have identified that this is what we classify as an error of complete reversal. Okay. Now, if we were to discuss the effect on profit for this correction that we have just performed, where we debited the salaries expense by $3,000 and we credited the cash at bank account by $3,000, what is the effect? When we calculate profit simply as the difference between all expenses and the revenues that we have got in the business, in simple terms, okay? So when we are debiting salaries expense by $3,000 as part of a correction, our expenses are obviously increasing in value. And when expenses increase in value, profits must go down in value, because you know profit and expenses, they have an inverse relationship, which means when one goes up, the other must go down, right? And also, what about the effect on assets? Based on the correction we have just done, we understand that we have credited the cash at bank account by $3,000, which means assets are going down by $3,000. So therefore, obviously, we understand assets are going down. Now, what about the third transaction in the question that we are given? Office equipment of $800 bought on credit was posted to the office equipment repairs account in error. All right. So this is what we classify as an error of principle. And the reason this is an error of principle is because the error is within the fundamentals. So what's the error that we're talking about? We can see clearly that the purchase of a non-current asset is incorrectly recorded as some kind of expense which has been incurred, right? So when this incorrect entry would have been done for increasing the expense, the business would have debited the repairs expense account. Is that not so? So how do we now fix it? So we reduce that expense account which was originally debited. So how do we fix this? So we credit the repairs expense account by $800, all right? And simultaneously, we understand we bought an asset. Therefore, our asset account, which is the office equipment at cost account, needs to increase. And when assets increase in value, we debit them. So we debit the office equipment account by $800. All right. Now, what is the effect on profit for this correction? So we can understand when we are crediting repairs expense by 800, we are reducing our expenses, and when expenses go down, profit must go up. And when we are debiting office equipment by 800, our assets are increasing in value because obviously we understand we fixed the error by reducing the expense and increasing the asset, right? All right. Now let's go to the next question. Complete the following table to show the effect on profit and assets of correcting errors 2 and 3. Error 1 has been completed as an example. All right, so we have already discussed error 2 and 3 for the effect on profit and assets, but let's discuss about error 1. So once we fixed error 1, what was the fix we have mainly done? So we included these two lines, right, where we increased the cash at bank account and we credited the sales revenue account. So when we increase the cash at bank account, our assets are increasing. So obviously for error 1, the effect on assets is that they're increasing. And when we credit the sales revenue account by 1,300, revenue is positively related to profit, which means the more revenue we've got, the more profits we'll make. So obviously, profits should also increase. So which is what the table has actually done. You will see they have already shown there's an increase in profit for error 1 and an increase in assets in error 1, which we have just proved. And we have already discussed error 2 and 3. All right, so now let's move to the next question. The following transactions took place during July 2021 with a credit customer, Beyonce. And you can see in the month of July 2021, on various dates, we have got transactions relevant to Beyonce. And there are some additional information under the table as well. The balance on Beyonce's account was still outstanding at the end of FADA's business financial year on 31 July 2021. FADA decided to write this balance off in full. So obviously what we can understand is that there is an irrecoverable debt coming into play. So what we're required to do in Part C is to prepare the journal entry and write off this outstanding balance at 31 July 2021. So what we're performing is an adjusting entry where we are writing off the bad debt or irrecoverable debt. So how do we arrive at the total amount for the irrecoverable debt? So we need to use all the transactions we have been given here. So we know that on the 6th of July, $2,100 of goods were sold to Beyonce, right? And on the 15th of July, some goods worth $280 were returned by Beyonce. So based on these first two sentences, we can derive the net sales revenue. And the net sales revenue is simply the difference between sales revenue and sales returns. So where we understand the sales revenue to be $2,100 based on the entry in July 6, and then the sales returns to be $280 based on the entry in July 15. So that gives us a net sales revenue of $1,820. Now, when you read the transaction in July 18, you see that Beyonce paid FADA $800 by check. So obviously, $1,800 is the original net sales that we have got after the returns have been processed. So once $800 in cash has been received from Beyonce, what Beyonce owes to the business is $1,020, right? Okay. Now, in July 22 and July 24, you will see that there are mentions regarding Beyonce paying the amount by check, but then the bank declined this because there were not enough funds, all right? And that is surprising for Beyonce. So $1,000, $1,020 is what is outstanding. And if FADA decided to write this off now at the end of the financial year as an adjusting entry, which is at 31 July 2021, what FADA has to do is to recognize that an expense has been incurred. And the expense has incurred because obviously FADA is suffering some kind of loss for this transaction, which they're sold on credit and now they're unable to recover the money. So there's a loss in economic benefit, obviously, right? So when an expense is incurred, we debit it. So we debit the irrecoverable debt account by $1,020, and simultaneously we credit the trade receivable account by $1,020 because Beyonce is no longer a credit customer once the returns have been processed and once the relevant write-off has been done, okay? Now, so what is happening based on this transaction? We're increasing an expense and we are reducing an asset. All right. Now, what about Part D and E? We are going to discuss those together. So explain why a business may decide to make an allowance for impairment of trade receivables And also name one accounting theory which justifies that we should make an allowance for impairment of trade receivables. All right. Now, let's understand the reason for doing an allowance for impairment of trade receivables. Okay. What do we understand by allowance for impairment of trade receivables? Allowance for impairment of trade receivables is a contingency measure that the business takes, and this measure is mainly taken because of our experience with credit customers in the past, where we have seen that not all of the credit customers would be willing to pay their debts off in time. So obviously, as a business, we must take a contingency approach where we prepare this contra asset account known as the allowance for impairment of trade receivables account. What do we understand by a contra asset account? A contra asset account is an account which records all the relevant reduction for another asset account. And the asset account in this case is the trade receivable account. But whatever reduction is likely to happen for this trade receivables in terms of potential sales not collected, we store it as a contingency measure in an allowance account, which is a contra asset account. Okay. And when contra asset accounts increase in value, we have to credit them. But when assets increase in value, we debit them. So it's just the opposite, as you understand, even in terms of the definition, where the allowance shows all the reduction for that asset. Okay. So what we are doing in this case is to credit the allowance for impairment on trade receivables account when we prepare a journal entry to record allowance, and simultaneously, whenever there is an increase in allowance for impairment on trade receivables, which means that compared to the previous year, this year, the amount that we may not collect from credit customers have increased, which means it's bad for the business. Obviously, it's a loss, so therefore an expense is being incurred. So whenever we have an increase in this allowance for impairment on trade receivables, the correct way to journalize it would be to debit the impairment loss on trade receivables, which is to show the expense that has been incurred, and to credit the allowance for impairment loss on trade receivables, which is a contra asset account, which when it increases in value is to be always credited. Now, obviously, we have talked about the contingency measure taken based on historical sales and experiences with credit customers. And also the prudence accounting theory justifies this, because what does the prudence accounting theory say? Assets are never to be overstated, nor should expenses be understated. So when we do an allowance for impairment on trade receivables, where is this being shown? In the statement of financial position in the balance sheet, we show the net amount for trade receivables, right? And the way we derive this net trade receivables, is to take the gross amount and then deduct the allowance. So obviously the net trade receivables is the asset amount which we're not overstating because we are factoring in the allowance. Okay. And that is where the prudence theory is valid, which justifies the recording of such allowances. Okay. And then simultaneously, when we don't understate our expenses by recording an increase in expenses, which is to debit the impairment loss on trade receivables, we are essentially not overstating our profits. So therefore, we are not overstating profits, nor overstating assets, nor understating our expenses, which means moving forward in the new financial year, we have a better understanding and in terms of decision making and how to allocate funds for operation, and also to come up with structures and arrangements and agreements to process credit transactions with customers. Because the whole point of running businesses is to learn and then improve, and to also increase your value for customers. All right. So if you can discuss this the way I've just discussed, which I'm pretty sure you will be, that's how you can exactly get full marks. All right. So that is all for this question today. I believe you found value in this content. Make sure to check our online coaching community for Sec 4 and Sec 5 POA 7087 students, those who are taking their exams in 2026. It is a year-long program, and at least the syllabus will be covered twice. And there will be many mock exams that you can attempt along the way before your preliminary exams and also after your preliminary exams to help you get an excellent result. So you can check the link in the description, and also With that being said, I'll conclude today's lesson and I'll see you in the next one.